Hello, everyone. Good morning, and welcome to today's Fireside Chat. So, when cars were invented, it was a huge success, but it had a major risk. If there was an accident, the driver or the passenger could get hurt. So, a big invention in cars was seat belts, which dramatically improved the safety standards. Cars have since kept improving with each new innovation. Similarly, the mutual fund industry has been going through a lot of evolution. There are new products which have come up which reduce risk, enhance returns. And in this context, let me introduce you to one of the most discussed topic these days, the SIF or the Specialized Investment Fund. Please join me in welcoming Mr. Bhavesh Jain from Edelweiss Asset Management. He's one of the key persons behind the fantastic success of Altiva Hybrid Long Short SIF, the first product in the SIF space from Altiva. Bhavish moved to Edelweiss AMC in 2011, and today he is the co-head for factor investing and manages flagship products like the Edelweiss Balanced Advantage Fund and the Edelweiss Arbitrage Fund. He's also responsible for their all their market cap as well as beta passive strategies and overlooks some of their commodities related funds. Bhavesh has done his master's in management studies in finance. With his sharp investment instincts, strategic thinking, and remarkable patience, he's equally comfortable managing portfolios, debating politics, playing cricket, or cards. Please join me in welcoming Bhavesh and hope he brings the same winning strategy to investments as he does to the card table. Thank you for being here, Bhavesh.
Thanks, Anulika, for having me here. Thanks to the Finvest team for arranging this.
Over to Amitabh and Bhavesh.
Hi, Bhavesh. Welcome for joining the call today. I think it's a real privilege. This is a topic, as Anuleka mentioned, which is very, very topical, very interesting. A lot is happening. And in less than a year, the industry has grown 10x. And you were one of the pioneers of the product with the first product being launched from the Altiva stable as well. So really, it's something which all of us are looking forward to the discussion. Also, a big thank you to all the folks who have joined in today on a Saturday. I know we have been having these conversations, and in that series, I'm really excited about the conversation today because today it's not just in terms of market. Today we are looking at talking some of the basics of the product. I know this conversation can go on for very long, so what Bhavesh and I will try and do and keep it a little focused so that we cover the key aspects of the product. So without talking much more around other things, I think the first, Bhavesh, let's straight dive in. What are SIFs? Your version of it.
Yeah, I think traditionally investor when they are coming to public market investment, they have multiple options to invest in, whether it was mutual fund, PMS, AIF. All of them have their own, you can say, challenges, and all of them have their own advantage. But now SIF, I will say, is a product which is getting best available traits of each of this vehicle, and all of them it is combined in a single product, and that in simple word is SIF for you. I will say it is you can say, if you have to explain in a single line, it is a product where you can say it is a mini AIF with mutual fund taxation. That is the, you can say, single line definition for it. But I think the crux of SIF is the flexibility given to the fund manager. So you can say SIF will be a product which will either give you can say, higher return with similar risk or similar return with much lower risk compared to all other vehicles available today for public investment.
Yes, I think that's a good starting point. Since you said it brings in the best of various products, so the natural next question is, what is different and similar as compared to a AIF, PMS, and a mutual fund in a SIF? So if you could just put down the key differences between these
Sure.
in a
So I
bit
will like
specific.
to, you can say, differentiate all these three categories with SIF on three parameter. The first one is accessibility. The second one is the flexibility part of it, and the third one is the structure of the overall product. So first, if you will see mutual fund today, anyone can access, anyone can invest. You can start with 100, 500,000, 5,000 rupees SIP, and you can have, you can say, it is a track record of more than 30 years. The size is more than 80 lakh crore, and there was a lot of ease of transparency which was always available. Now, when it comes to PMS and AIF, the minimum ticket size is as high as 50 lakh to 1 crore. So there was a huge gap. There is a product where you can start with 100, 200, 500,000 rupees. And then if you have to upgrade yourself, the next available product is directly at, you can say, 50 lakhs and 1 crore. SIF in a way bridge that gap of accessibility because you can start in SIF with a much smaller ticket size of 10 lakh across all SIF strategies put together. So right now, regulator have approved seven strategies. So on an average, with 1.5, 2 lakh rupees in each of these five or six product, you can access SIF. Second, and the most important part is the flexibility. Today, mutual fund by default are long only in nature. Even if you are negative on overall market or on a particular sector or on a particular stock, at best you can take is either a hedge position or a cash call. Even if your view go right, market goes down, the sector goes down, or the stock goes down, at best you can just protect your losses. You cannot profit out of it. In SIF, if you see on the other side on AIF, there is all the flexibility. You can take leverage, you can use derivative, you can take long, you can take short. All the flexibility of the world is available. SIF again is somewhere in between. As I said, it is a mini version of an AIF. So here they've allowed you the freedom to trade derivative. You can be long only mutual fund, you can be long only SIF, but at the same time, they have allowed up to 25% naked short exposure also in SIF. So earlier, you can say taking negative view on a position or on a particular stock or a particular sector was allowed only in AIF, but now in SIF they have allowed it. So you can say compared to a mutual fund, the flexibility in SIF have gone up significantly. Second biggest challenge was mutual funds were very tightly regulated. So if you will see, it was a large cap fund. 80% of large cap money should go in the same 80, 100 stocks for all the fund managers. If it is a mid cap fund, 65% of your AUM have to go in the same 150 stocks for all the fund manager. In SIF, there is no such restriction. Mutual fund regulation tells you where a fund manager can invest. In SIF, the regulations are more lenient. It is only telling you where you cannot invest. Like in X top 100, you cannot invest in top 100 more than 65% of your AUM. If you are taking short exposure, you cannot take more than 25% short exposure. So it is just telling you where you cannot invest, but it is not guiding you where you have to invest. Like in mutual fund, the regulations are very clear where you have to invest. So that is the flexibility part of it. And third, I think the biggest advantage of SIF is the structure where entire regulation of mutual fund taxation is as it is passed on to SIF. So the biggest challenge for AIF was you got all the flexibility, you got opportunity to leverage, use derivative, but all this advantage was getting killed by a single challenge that was taxation. Irrespective whether you redeem or you don't redeem, the fund on whatever profit they have booked in the financial year, the fund has to pay tax. And in most of the cases, the tax rate is as high as 39%. The whole advantage here is shifting towards a mutual fund and SIF because in SIF, even as a fund manager, if I do 1,000 trade, I don't pay any tax. Whereas PMS fund manager, whenever they churn their portfolio, whenever they trade, individual clients have to pay tax. Here, till the time you don't redeem, neither I pay tax, neither you or your client pay tax. But in AIF, irrespective whether you redeem or you don't redeem, the fund has to pay tax every year. So the benefit of compounding, lower taxation, equity taxation advantage of long-term, short-term capital gain tax, everything is available to SIF. So you will see all the three parameter, accessibility, much lower ticket size compared to a PMS and AIF, flexibility, significantly higher compared to what it was for mutual fund, and structure, particularly taxation, it is as good as mutual fund. And other than taxation, I think entire simplicity of mutual fund, publishing daily NAV, daily liquidity, you can invest on a daily basis, In few SIF, there is restriction on redemption on a daily basis. But compared to an PMS or AIF, like where in AIF where you redemption have once in a month or twice in a month, here you have redemption almost daily for all equity products, twice in a week for hybrid product, once in a week for debt SIF. So relatively, you can say much closer to mutual fund on ease of doing, you can say purchase and redemption, etc. So on all the three parameter, I think SIF wins hands down compared to all the three public investment vehicles like mutual fund, PMS, and AIF.
Well, that's gives a lot of clarity. Of course, the suitability of product for taking some is something which we always need to keep in mind. And one more thing which you mentioned, in SIFs, leverage is not allowed. So therefore, to that extent, it does protect in a lot of ways compared to AIFs. But looking at the point which you mentioned, which is different, which is new for a lot of clients who have not used PMS or AIFs as extensively as well, derivatives is something which comes into play. As you said, naked shorts are allowed, long shorts are allowed. So if you could give us a certain sense of, you also manage a fund, how do you look at derivatives? How much of a risk do you take? How do you use it to mitigate, especially in the hybrid category? Or in some of the other categories. So how do you look at derivatives, and how much are people taking a lot of risk in the derivatives which you are using in a SIF structure?
So I think there is a big, you can say, myth or a misconception regarding derivative. Not necessarily derivative always means higher risk or higher return. Today, you see even on mutual fund platform for last 15 years plus or almost 20 years, mutual fund is managing a category which is heavily dependent on derivative. That are all your arbitrage fund. That is, today I will, if you ask me, the safest equity product is arbitrage fund, which is 100% dependent on derivative. Then look at some of the low volatile solutions for your equity investment, balance advantage fund, equity saving fund, heavily using derivative to reduce your volatility. So derivative, it is more about, you can say, how you use it rather than, you can say, what risk you carry on using derivatives. So I think in SIF, the biggest advantage we get is to express our view on market in multiple front. It is not only about taking a long position or a short position, but also using derivative for arbitrage, using derivative for hedging, using derivative to generate extra income in strategies like covered call and protective put to give you downside protection in a significant volatile environment. So there are different ways in which derivative can be used. Not necessarily always a derivative will lead to high risk and high return kind of, you can say, proposition. Here in SIF, our thought process is very clear. We want to use derivative in such a way that it leads to much better risk efficient and you can say low volatile experience for our client. We are not using directional short. We are not using, you can say, anyways, leverage is not allowed. So that is also not a challenge. But other than that also, we are not taking significantly, you can say, diverse position using either extremely, you can say, long side of the trade or either on the short side of the trade. We are using derivative for multiple purpose, but as I said, the purpose of the flexibility given in SIF, it has to be taken very, you can say, carefully, because with flexibility comes a lot of responsibility. In case if normally if you will say derivative is known globally, the famous saying derivative is known as a weapon of mass destruction, but that is only if you don't know how to use it in an efficient manner. That's why we always say derivative, it is more about, you can say, using it with a lot of care rather than, you can say, just thinking that I am getting flexibility to use derivatives, so I will use it left, right, and center. That is not the case. Most important traits of derivative trading always have been how much to use it, when to use it, and most importantly, when not to use it. If you are able to manage these two or three things, I think derivative can be a significantly useful tool to improve clients' experience over a long period of time.
Fair. And I think this is where this product is scoring, even in flat markets where the use of derivatives is helping generate some returns without taking any extraordinary risk. Uh, so there are two categories. As you mentioned, there are many categories which the regulator has permitted. There are two categories where we are seeing some amount of traction. One is the hybrid long short category, and the other is X100, X top 100 long short strategy. What are the use cases for these? If you could go a little bit more detail about these two categories.
Sure. I think, see, the biggest advantage of SIF as a platform is the flexibility given to the fund manager. Now, the same flexibility can also become a big challenge for investors and distributor, because now it is not easy for anyone to compare different products within the same category. Like, if I just take a step back, today when you are comparing any mutual fund scheme, so you compare them category wise, like you will compare all large cap funds together, all mid cap fund together, all small cap fund together, and then you will evaluate a fund on the basis of either returns, risk, volatility, and then you will select this is a good fund, this is an average fund, this is an underperforming fund. But in SIF, that practice no longer is true, because within a category, like within hybrid long short fund, Edelweiss is running an arbitrage plus strategy. There are other AMCs. Someone is running an income plus arbitrage strategy. Someone is running a credit fund within hybrid long short fund. Someone is running a balance advantage fund. Someone is running an equity saving fund. So it is very difficult for anyone to compare all the products of the category just by looking at the name. And that's why you have to deep dive individually in each of the strategy. For Altiva or for us, if you'll see the two categories, what we have, and as you rightly mentioned, these are two of the, you can say, most popular category as of now, as far as flows are concerned, hybrid long short fund and X top 100 long short fund. Now, our thought process in these two category might be totally different from what a lot of other players in the category are trying to do. So I'll first just give you a simple, you can say, update on the category, and then maybe we can discuss in detail about the difference between different product. So the first category is hybrid long short fund, where the regulation has given you the maximum flexibility. The only regulation over here is minimum 25% should be in equity and minimum 25% should be in debt always. Balance 50%, you can choose whether you want to keep in equity, debt, hedge position, arbitrage position, long position, short position. Individual fund manager have that freedom. And that's why I told you, because of this freedom, there are funds ranging from income plus arbitrage and credit on the fixed income side to all the five, you can say, hybrid fund on the mutual fund side. So arbitrage fund, equity saving fund, balance advantage fund, aggressive hybrid fund, all of these products are available in this category. Now, our thought process have been very simple. If you'll see, if our clients, the biggest problem what they are facing today is to have an appropriate fixed income solution. There are multiple equity products for aggressive investor, conservative investor, but for a fixed income investor, after the benefit of indexation has been taken away, there is hardly any product which can give you post-tax return of 7 to 8%, which earlier you used to get when indexation benefit was there. But now you don't have any such product. Fixed income fund post-tax is not giving you more than 5.5%. Replacement to that to some extent was arbitrage fund, which still gives you liquid plus 50 to 100 basis point. But on an absolute basis, you are now talking about return of 6.5% post-tax. This is something where there is a huge gap from 7.5%, 8%. Now you are getting return of 5.5 to 6% in a best case scenario. That is where we thought if we launch a product where our intention will be to deliver returns of arbitrage plus 2 to 3% over an 18 to 24-month period. But if we are able to launch this product without taking meaningful equity risk, like an equity saving fund or a balance advantage fund or a multi-asset allocation fund, where you will always have some percentage of naked equity exposure always. So that is where Altiva Hybrid Long Short Fund comes into picture. Our intention in this product is to give you a fixed income kind of product with slightly higher volatility. If you look at our standard deviation, it is in the range of 2.5 to 3.5%. And the target return, as I told you, is arbitrage plus 2 to 3%. If I look at 10-month return, what we completed just, you can say, a couple of days ago, in our regular plan, we have delivered return of more than 12.25%, which is significantly higher compared to what arbitrage funds ideally give you. But as I said, the most important thing is the kind of problem we are trying to solve. A fixed income investor, if they want to get better tax adjusted return, I think this is the product suitable to them, wherein if you can stay invested for, you can say, a longer period of time, your experience will be much better compared to any other fixed income product which is available in market today. Same thing if you will see, so here we are using derivative extensively. In Altiva Hybrid Long Short Fund, we are using derivative for doing arbitrage, for derivative for doing hedging, a lot of derivative for doing covered calls, straddle and strangle, and then also derivative to do a lot of special situation trades like open offer, buyback, merger, where we hedge our position. But if you go to the next product, X Top 100 Long Short, again, nomenclature wise, if you will see, both of them are known as long short fund. And that is the regulation wherein all SIF strategies will be known as long short fund. Whether I use short or I don't use short, it doesn't make any difference. All of us are known as long short fund. In fact, when you talk about our X Top 100 fund, where again we have taken a totally different stance, here we have decided we will not even use derivative. You can say to a larger extent, almost 90-95% of our portfolio will not have a single rupee exposure of derivative. Same product on SIF platform, same long short category, but use of derivative will be bare minimum. Why? Because again, here we are trying to solve a different problem. Today, this is a product wherein we are targeting all the PMS available in the market. The advantage of a mid cap fund or small cap fund on a mutual fund platform compared to that, when you look at the PMS, the advantage for PMS was, you can say, high concentration portfolio, limited stock, high exposure, high conviction, and that's why you are trying to generate alpha. In mutual fund, when you look at most of the mid cap and small cap fund, there is no single category which is known as mid, where I can take exposure to both small cap, mid cap, or to that extent to even a micro cap. In mid cap, the regulation tells me 65% should be in mid cap stock. In small cap fund, the regulation tells me 65% should be in small cap stock. But here in X top 100, the regulation tells me 65% should be out of top 100. Now, whether that out of top 100 is mid cap, small cap, micro cap, long, short, multi cap, flexi cap, fund manager has to decide. And that is where our X top 100 fund become a very unique idea, wherein we are trying to compete with all the available PMS in the market and try to give you an efficiency of taxation. In PMS, every time a fund manager moves from stock A to stock B to stock C, individuals have to pay tax. Here in mutual fund format, the taxation is very efficient. As a fund manager, even if I move in and out of stocks 100 times, I don't pay any tax. And if you don't redeem for 3 year, 5 year, 7 year, you and your client also doesn't pay any tax. So that is the problem what we want to solve when it comes to our X Top 100 Long Short Fund. A high conviction, high concentrated portfolio of 40-45 names, 90% always deployed in equity stock of universe from 101 to 750 market cap company. So broadly 650 stocks. Out of this 650, we will have a portfolio of 40 to 45 stocks, and it will be always deployed. 90% of the portfolio will always deployed. Remaining 10%, you can say, will be either be deployed in mid cap or large cap, or my cash call, or my derivative trades, or my special situation trade. Anything other than this 90% will be restricted to the balance 10%. So whether I have to use derivative, whether I have to take large cap, whether I have to take some cash call, it all this put together can never be more than 10% of my portfolio. So this is again, as I told you, a unique approach wherein we are saying we will not take any cash call. It will be a high conviction, concentrated portfolio, high risk, high return. And then that is why here we are differentiating on the basis of taxation and construction of the portfolio rather than using derivative. So that is why I told you each of these category will have a lot of difference within themselves. So there is some X top 100 fund which are taking long and short position. They are going long on high conviction idea and taking short position in overvalued stock, etc., etc. We don't want to take short exposure in this fund. So that's why you have to evaluate each and every product separately.
Fair. And I think what you say makes a lot of sense that even within the categories, there are very significant differences in strategies. And therefore, again, what is suitable for a client, even within a set category, is something which we need to look at. So what we will quickly move to, you did cover some of the rationale of the products from Altiva, which is in the SIF category, the brand in which the product is distributed is different from the main parent brands. Edelweiss is called Altiva, and from a regulatory perspective, you have been a fund manager for the long short fund. How has been your experience?
I think the journey the small journey, I will say, this just the start, but has been quite rewarding, and you can say a lot of learning. Most importantly, if you will see, when we started, we were the first one to launch. So a lot of, you can say, clarity was missing, which, as I told you, within hybrid long shot, there were 5 or 7 different combination what we could have chosen. So which one is the right approach? Which will be the one which get maximum success, both from returns point of view and AUM point of view. So there were a lot of questions at that point of time. But the clarity what we had, that if this is the biggest problem our clients are facing, and if we are able to provide a solution to this fixed income problem, I think we will get the best, you can say, success for the efforts we put in. And now, after 10 months, I can say the journey has been quite rewarding. We started with a small NFO collection of around 300 crore. Today, as we speak, we are at 8,600 crore. We ourselves, if you ask me frankly, we never thought that this will be a product which will scale up so quickly. I am managing Edelweiss Balance Advantage Fund for last almost 15 years, Edelweiss Arbitrage Fund for last 12 years. After running this fund successfully for 12 years and 15 years, today our AUM is in the range of 13,000 to 16,000. And this is just a 10-month-old product, and we are already moving towards a 10,000 crore journey. So that is quite rewarding. I think the most important lesson what we run over here is, it is not necessary for you to always take extra risk to generate extra return. You don't have to be right every point of time. You don't have to predict the next move of Nifty every point of time. If you are able to use the different vehicles of, you can say, generating returns given to you under SIF, if you can use all of them optimum in an optimum way, irrespective whether market favors you or market doesn't favor you, your view go right or doesn't go right. If you have diversified across strategies, I think more often you will be able to get much better return compared to your own expectation. So if you will see, the target what we set for ourselves was arbitrage plus 2 to 3%. Normally, that number, if arbitrage is 6.5, this product was intending return of 8 to 9%. Today, if you'll see the journey, we are sitting at a gain of more than 12.5%. But more importantly, we have delivered this 12.5% in a period where Nifty has given you negative 7.5% return. This is the 10th month what we have seen is one of the most challenging period for equity investor, because 7 out of last 10.5 months, markets have given you negative return, which is a very rare event. If you look at history, 7 months in 10 months being negative, this has not happened more than 2 or 3 times in last 15-20 years. Then in addition to that, we saw March 26, which again was a very rare event. Nifty was down more than 11% in that month. Historically, if you will see how many months Nifty is down double digit. So before March 26, it happened in March 20, which was the COVID month. And before that, it happened in 2011. So an event which happened only 2 times in last 15 years happened immediately within 6 months after the launch of our product. And even after this challenging environment where 7 out of 10 months are negative and a single month fall of double digit has already happened, even after all these challenges, we are sitting at a significantly higher return compared to our own expectation, because the diversification helped us. If you will see our strategy, we have divided into multiple buckets. We have taken a sizable portion of our portfolio on the fixed income side. Almost 50% is in AA and AAA rated fixed income instrument. We have also taken 10% of our portfolio in T-bills, which is used as a collateral for derivative trading. So 60% debt is helping us to generate stable return irrespective what happens to equity market. We also do a lot of arbitrage. So almost 10% of our portfolio is in pure arbitrage. That again is a market agnostic strategy that have its own, you can say, comfort to deliver better risk adjusted return. And then almost 40% of our portfolio we have deployed into equity and derivative strategies, which now are allowed under SIF. So debt, arbitrage, etc., was always allowed in mutual fund also. But here, 40% of our portfolio is in equity and derivative strategies like covered calls, straddle and strangle, which till date is not allowed in mutual fund. So in last 15-16 years with mutual fund, we have never experienced all these opportunities. But now we were doing it for the first time. And I will say, touchwood, for first 10 months, we have been able to do a lot of justice to this thing. And that, again, as I told you, is another set of diversification. It is helping us. Plus, we also do a lot of special situation. IPO, open offer, merger, demerger, buyback, so many things. And then markets, if you'll see in bull market, you will see a lot of IPO. In bear market, you will see a lot of buyback and merger and open offer. So some or other trades will always be there. So the benefit of the biggest learning for us on SIF platform has been, if we are able to well diversify our strategies, if we are able to manage risk of all these strategies, more importantly, the correlation of different strategies in different market environment. If you are able to manage all these things, I think you can get much better market agnostic return. That is actually what a true hedge fund or a true long short fund is expected to do, irrespective of market, you can say market volatility, irrespective of market supporting you or not supporting you. You are supposed to deliver absolute return month after month, and that is something we have been able to do. And that is, I will say, the platform itself is so robust that there are high chances that as time passes with more and more AMCs launching SIF, I think this can be a big, you can say, a competition to existing a lot of existing mutual fund products also.
Right. So my last question before we move to the other segments of our discussion is, I think the early success has meant that almost 40% of the market share of the SIF industry is with Altiva. And I think that's a great achievement. And as you said, lot more products are getting launched, a lot more diversification will happen, and this is the segment which will grow. So in quick 2, 3 lines, what next from Altiva in the SIF space?
I think, see, for us, we are very much clear. We don't just want to launch product because there is a category available to launch. We will be very thoughtful about launching any product. So the first product was a product where we were trying to solve your fixed income need. Second product where we tried to solve your mid cap and small cap needs. And in the third product, again, we are going to solve a big challenge what today an investor is facing is on the large cap fund. I am managing Edelweiss Large Cap Fund for last almost 12 years now. It is a good product. We had a good track record. But when you look at our performance, almost our performance is plus or minus 50 basis point compared to the benchmark. And we are one of the better performing large cap fund. So that means generating alpha in large cap is very difficult, very, you can say, challenging, because the category is well researched. There is no information arbitrage, and the regulations have become very tighter. 80% in 100 stock for each of the fund manager. So rarely there is an, you can say, a fund which outperforms on a consistent basis for a long period. So now what are the challenges for investor? First, alpha is missing. Second, the fund which I select, what is the guarantee that it will outperform for the next year or underperform the next year? We don't know. Third, there is a lot of competition from passives and hybrid from both the sides, so squeezing the category completely. So that is where we are launching Altiva Equity Long Short Fund next month on 10th of September. This is the product where the target is NSE 100 plus 3% return over an 2 to 3 year period. Now, like in Altiva, it was arbitrage plus 3%. In X Top 100, it is in a way mid cap PMS plus 3%. Same thing over here. The benchmark for us is large cap NSE large cap 100, which is the benchmark for all the large cap fund. Today, as I told you, more than 70% of the large cap funds are underperforming this benchmark. Look at passive fund, almost 100% of passive funds are underperforming this benchmark. So today, active fund have AUM of more than 4 lakh crore, and then passive funds have AUM of more than 8 lakh crore. So almost 12 lakh crore worth AUM in equity is sitting into mutual fund schemes tracking NSE 100 as the benchmark, and NSE 100 or large cap as the benchmark. And we are trying to compete with all this by launching a product wherein we will have an equity large cap oriented portfolio. So almost 80% large cap and 20% others. And over and above that, we'll be doing a lot of derivative overlay. So strategies like covered call, strangle, etc. Protective put, covered call, all of those strategies. And intention will be to generate post fees return of almost 3% over and above the benchmark. If we are able to deliver that, look at long-term return of large cap, it will be around 11%. Look at long-term return of mid cap, it will be around 14%. So here we are trying to give you 11 plus 3 equals to 14. So mid cap kind of return with lower than large cap volatility. So as I told in the beginning, the objective of SIF for us is very simple. Either we have to give you higher return with similar risk or similar return with much lower risk. So that will be the test for any of the product what we launch. If we are not able to meet this objective, we will not launch product in that category.
Right. So what we'll do, we'll take a pause now from this segment and make it more interesting and more interactive. So what I'll do, I'll ask Anuleka to come on board and do throw a few rapid fire questions at you.
So no thinking, just quick
Yeah.
answers, Bhavesh. One market myth which you wish investors would stop believing.
I think you don't have to be right always to make profit. Your risk management strategy should be better.
One strategy you think is underrated today.
Hedging, normally people think that hedging is a cost. We think hedging is the cushion which allows you to take risk in an appropriate manner. So you should never ignore hedging.
One strategy you think is overhyped.
Uh, I'll not say it is a strategy, but it is like a human trait to just follow the herd mentality. Like you can say, everything which is working well, I have to participate over there. It is not necessary. So we have seen silver at 4 lakh. We saw maximum flow in our gold and silver ETF at that point of time. Today, if you'll see just 6 months ago, a lot of flows going into international market, just talking about AI, Korea, Taiwan. Suddenly, Korean markets are down 40%. So don't follow the herd mentality. Everything is not necessary and everything is not required for you. You stick to your asset allocation. That is the most important thing.
What's harder, finding an opportunity or knowing when to exit?
I think obviously the answer is quite simple. When to exit, because opportunity you will find from multiple places. It is more of, you can say, analysis and grabbing them. But exit is very difficult because it is more of emotions which comes into picture. It is more of, you can say, psychological behavior which stops you. So I think exit is always a challenging task because no one wants to accept that I'm wrong.
What's the first thing you check when you start your market day?
Uh, uh, So normally we do look at global markets, but rather than just looking at the headline numbers, it is more about what it is not what happened to, you can say, Dow Jones or what happened to Gift Nifty. It is asking the question why, so that we are updated, we are informed before we move to the markets for the day. We are aware of what has happened, and basis that we have to take decision.
Or
So
what's
we don't just
happened?
look at number,
Yeah.
but why it has happened.
If you weren't a fund manager, what would you be doing?
I think something in market only, or if not, then the second best option would have been I would have been a coach or a teacher for finance, or at least for derivatives, I can say.
So now we know whom to call if we have questions.
Yes.
If the markets were a cricket match, what phase are we in right now?
So I think if we are, you can say, in those difficult overs where you can say there are a lot of fielding restrictions, and the you are not in the slog over also where you can go for all out hitting, you can take that risk, but also you are not in a phase where you can be extremely defensive. So it is the middle over, you can say. You have to slowly and gradually select your shots and try to, you can say, move out of this phase without a lot of damage.
Okay. Um, how do you see Indian markets currently, fold or double down?
So again, if I take, you can say, extend this from the cricketing analogy, I think it is neither the
In
time
the
to
middle.
fold and neither the time to double down. As I told you, this is a grinding phase. You have to survive. So survival is the most important, you can say, element of this juncture. 2 year of hardly any returns, a lot of global headwind, whether it was AI, whether it was trade, whether it was war, crude oil price. But fundamentals of India story remains equally important. So yes, you can double down in selected pocket now, but not double down overall on the market. So there are selected pockets which provides you a lot of opportunity. So that is how I will, you can say, in a way, distinguish between different sectors or different opportunity at this point of time.
What do
You
you
would have
do?
seen our ad recently. You would have seen our recent ad. Don't quit India. So obviously not a market to fold.
What do you do to completely switch off from the markets?
Yeah, I think family time. So Saturday, Sunday, anyways, are the, you can say, the best days on the week where we don't have to worry about the market. And that is the time which we like. Normally, I like to spend with the family, almost couple of movies, some outing, some trip. But even if there is no such thing, even the good quality time at home, that is the biggest, you can say, unwinding trade for us, and we do it quite often. And again, so my family is not interested in market, so anyways, we don't discuss market over the weekend.
Okay. Describe your investment philosophy in 3 words.
So I think I started my career in 2008, just you can say at the start of global financial crisis. So for me, it was always risk before returns, and that's why I've always, you can say, focused on three traits, which is discipline, process, and patience. So that is how the entire, you can say, journey started, and that's why you will see most of the products which I manage are hybrid in nature rather than pure
Yeah, the
directional in
risk is
nature.
managed.
Yes.
It's been really nice to hear your thoughts. We have a lot of questions coming in from our clients. So, Ayushi, would you like to start the question answer?
So Nitish Mittal has asked, uh, how is the expense ratio of SIFs compared to regular mutual funds and within different SIFs also? How is it? How are expense ratios determined?
So I think, as I told you, for all practical purpose, SIF is just an extension of mutual fund. So here also expense ratios are slab wise. So you start in equity mutual fund or equity SIF with the maximum slab rate of 2.1%. And then with every, you can say, slab, the expense ratio keeps on coming down. So right now, if you will see in our Altiva hybrid long short fund, we started with an expense ratio of 1.85% in our regular plan, because it was not a equity oriented scheme, neither it is a fixed income oriented scheme. So that's why regulation wise we are charging fixed income expense ratio. So we started with an expense ratio of around 1.8, with AUM growing to almost 8,600. Now the expense ratios have come down to, you can say, incremental expense ratios have come down to 1.35, 1.4, much lower than where we started from. And it is true for all equity SIF and on all fixed income SIF also. It will be slab rate wise, similar to mutual fund.
So Nitish, exactly
Just
same as
a,
mutual
just a
funds,
minute.
no different.
Yeah, Bhavesh, can I ask? Bhavesh, this is Nitish Mittal here.
Yes, yes, please.
Yeah. Similar to the question which I asked regarding SIF, just wanting to understand, like you told, it is up to around 2%. Some of the funds even have 4% expense ratio. So does that expense ratio means that if the earnings from the SIF is 15% and expense ratio is 4%, so I am getting 11% in return. Is it like that?
No, no. So I think
No.
you are looking, or you are talking about the data of BER versus TER. So I will tell you, as per the new regulation, all AMCs are in a way are declaring two numbers now. So the number which I told you is the BER, the base expense ratio. This is the fees what an AMC charges, like 1.35%, 1.85% to start with, and now 1.35. This is what an AMC charges, which include distribution cost, AMC fees, R&T charges, and different charges what we pay. The number what you are talking about, over and above this BER, there is are more charges like brokerage and STT and stamp duty and exchange fees and SEBI turnover fees, which we pay when we trade. And now, as per the new regulation, whatever trade we do in a month, we have to analyze that number and publish that in TER. So that is where that number of 4%, 5%, 6% on some days you will see comes into picture. So just I'm giving you an example. Today I launch a new product. You gave me 100 crore. I deploy that 100 crore today. The cost of deployment, I will buy say 100 crore worth simple stock, Reliance and all the nifty names I bought. For 100 crore stock, I will pay 10 basis point STT and 6 basis point brokerage. So my cost for deploying this 100 crore will be 16 basis point. Now the regulation tells me to analyze this number. So now if one day cost is 16 basis point, if I analyze this number, that means for 10 days, my cost will be 1.6%. For 100 days, my cost will be almost 16%. And for 300 days, the cost will be 50%. So suddenly you will see the expense ratio is 50%. But this is just one day expense. We are analyzing that number. And it is not that every day I will incur 16 basis point, and that's why that annualized number is a wrong number to look at it. So, but the regulation is the way it is, and that's why I told you a simple example will always help you. If you deploy 100 crore, your TR for that particular day is 48%, but you are not going to incur 48% cost. But this is one day cost and multiplied into
So,
365 days.
so
That's why you see this anomaly.
Bhavesh, just to add here. So in terms of Nitish, the expense ratio works exactly the same as mutual funds. So there is absolutely no difference. Like what Bhavesh said, SIF runs on the mutual fund platform. So the taxation expense ratios are exactly the same. Similarly, as mutual funds, the NAV is post the expenses. So is the case in SIF. So there is no difference. What Bhavish was trying to tell was a technicality within that because of a daily declaration. Now, even in mutual fund, the day the transaction happens, that day, but on an average of the year, that wouldn't be the case because that is of the daily NAV declaration. That's just a technicality. I don't think that makes a difference from an overall returns. So the way
And
mutual funds are exactly the same as SIF, no difference on this front.
And then just to add, Nitish, when you look at returns of 13% or 12%, this is after excluding all the costs. So we have already, you can say TR, BR, brokerage, STT, stamp duty, management fees, everything is charged, and then your NAV is calculated. So your returns of 12.5%, what you see in Altiva Habit Long Short Fund, is after excluding all the costs. So you don't have to pay any extra cost over and above what you see on your NAV return.
Okay, thank you, Bhavesh.
Thank you.
Okay. We have a question from one of our clients. If I already have a balance advantage fund and an arbitrage fund, what additional role would a hybrid long short SIF play in my portfolio?
I think if you have an arbitrage fund, very simple, you will get much better return adjusted for the slightly higher volatility what you will see. For balance advantage fund, I think more or less both of us will give you similar return in the range of, you can say 9 to 11%. But in balance advantage fund, your volatility is half of Nifty. So if you'll see Nifty, balance advantage fund and hybrid long short fund, all three of them over a long period of time should give you 10 to 11% return. But Nifty will give you 11% return with a standard deviation of 13, 14. Balance advantage fund will give you 10 to 11% return with a standard deviation of 7, 7.5, almost half of Nifty. And Altiva hybrid long short fund again will give you similar return with a standard deviation, half of balance advantage fund in the range of 3 to 4%. So return wise, almost same, but drawdown and volatility will be much lower over here. So it is more of taking view on equity market rather than you can say selecting this product. If you are extremely bullish on market right now, so I think balance advantage fund will have a great you can say experience compared to an Altiva Habit long short fund. But if you feel that markets are going to remain how they have been for last 2 years, then Altiva will give you a much better experience. After 5 years, both of them may have similar return, but in between the first 1 or 2 years can have a huge difference.
Fair, fair. Okay, I have a loaded question from our client, Mr. Sanjay here. What are the biggest mistakes in your view that investors make when following fund managers or market experts? What is the hardest part of staying disciplined as an investor? And which mistake do you often see experienced investors repeat?
I think the biggest mistake what a lot of us very frequently make is we feel that if you have 10 different things to, you can say, use, you want to use all of them. Like as I told you, it is not necessarily for us as a fund manager to trade on a daily basis. It is not necessary for a fund manager like us to react on each and every news on an immediate basis. We have flexibility to trade derivative, to do options, to do so many things. The biggest mistake is a fund manager normally feels, or an individual also normally feels that if I'm not using it, I'm wasting it. So I have to use it in some shape and format. And that is where actually the mistake happened. So again, from an investor point of view, we always say, don't just look at the fund manager, look at the process. Fund manager may stay or may move out, but your money will not be easily moving out because you will be looking at exit load, taxation, so many other costs. So for you, it will not be easy to move out. So if the fund house have a disciplined approach, have a process-driven approach rather than a star fund manager concept, then that house will always have more stability. So if you will see in Edelweiss, we have been always rewarded for consistency rather than top class performance. None of our fund will be number one in ranking on a 1 year basis. But when you look at on a 5 year basis, almost all of our funds will be on number one ranking or number two ranking in their respective category. Because we always believe if every year we are in top half or top quartile every year and we are not going down to the bottom of the table, over a 5 year period, over a 3 year period, over a 7 year period, automatically off all our funds will be at the top of the chart. Because someone who is rank 1 today, high chances that tomorrow he will be rank 40. And because if we stay in rank 5, rank 10 always, automatically after a 5 year, we are number one, number two in all those categories. So consistency is more important rather than you can say one-off great performance.
Thank you. Next question is from Mr. Samir. Thank you for joining in. Being a PMS customer, what do you envisage will be the future of PMS, given the introduction of SIFs? Should he, as a layperson, start worrying for PMS performance and start moving funds from PMS to SIFs? Or should remain invested with PMS for the sake of diversification, as target returns for the long-term strategy are different in both?
So I think see each investment vehicle have their own advantage and have their own challenges. I think with SIF coming in, you would have already seen a couple of Cat 3 long short AIF have already shut their shop. A few are in the process to get mutual fund license, and definitely they will also move their AIF strategies onto SIF side. So post-tax return will definitely be a big talking point and big key, I will say, ingredient to decide where I have to invest going forward. And over there, both compared to an PMS and compared to an AIF, mutual fund taxation of SIF wins hands down. But again, if you will see within PMS, there are some extraordinary fund managers who have been able to deliver great return even with all these challenges. So if you are able to find one, definitely even after paying higher tax, you will still get better return. So that is where I think the selection of right fund house, right fund manager, and the right you can say investment process will become equally more important. And I think other things being equal, taxation advantage standalone gives SIF a big advantage. Plus the flexibility to trade derivative, which I think there are some new regulations on PMS also, which gives some of this benefit to a PMS fund manager also. But I think SIF, because of you can say different other parameters, the mutual fund ease of operation, transparency, monthly portfolio disclosure, daily NAVs, etc., gives it a lot of comfort. That is the reason today you will see for retail and a lot of HNI investor, mutual fund is still the go-to product. And for you can say ultra HNI and some of the sophisticated investor, PMS and AIF was the tool. So this is the product which will bridge that gap. So you have to you can say give SIF some more track record time to build some track record, and maybe after a couple of you can say more quarters, once you have track record of 1.5, 2 years, then you can take that call whether you should move out or allocate incremental money to SIF rather than PMS. But you have to give some time to SIF. 9 month, 10 month is still relatively a very small period, and we have just seen one side of market. For last 9, 10 months, markets have remained choppy. Once we see a bull market or a big bear market, then the true potential of any product will be visible.
Right. And also, I just want to add, in terms of within SIF also, at this point of time, number of products, number of participants, number of players are limited. It's being built up, and a lot of them are even newer. So in different areas. So, but clearly from a structure perspective, SIFs have strength, a lot of strength. But from a strategy perspective, fund manager perspective, I think those are still to be fully demonstrated, as Bhavesh was saying. So I wouldn't recommend jumping into it and taking calls and moving from one to the other very quickly, but incrementally, gradually. The reason why we also scheduled this call today was that this looks like a very interesting space. In less than a year, this space has grown from 2,000 crore to a 25,000 crore AUM industry. And I would be very surprised if it doesn't touch 5 lakh crore AUM in a fairly short period of time. So there's significant growth happening in this space. Everybody we always recommend diversification, dipping your toe, figuring it out, have an experience so that as the opportunities unfold, you would be in a much better places to evaluate. We should only do things which we understand. We shouldn't do anything which we don't understand. And therefore, this call itself is a step in the journey of how SIFs are getting popular. They're definitely getting popular. They're definitely getting a lot of traction, but in a phased manner, in a comfortable manner, we should scale it up.
Yeah. And just to add, if you would have seen mutual fund flows, last month the total flow in mutual fund was 30,000 crore and in SIF was 5,000 crore. So just see almost incremental 1/6, 1/7 of mutual fund flow for that particular month is already in SIF. When I look at Edelweiss flows for last 3 months, I will say more than 50% of our net flows have been in SIF. So rightly mentioned by Amitabh, this is a fast growing category. As I told in the beginning, we took 15 years for Balance Advantage Fund and Arbitrage Fund to reach in the range of 13 to 16,000 crore AUM. Here in just 10 months, we are already touching 9,000. And on almost on a daily basis, if we get flows of 80 to 100 crore, I think by March end, this will be the largest hybrid fund in Edelweiss Kitty. So that is how quickly the category is growing.
Thank you. Mr. Dharamveer, do you want to unmute yourself and ask the question?
Thank you. Thank you for giving me the opportunity. And first and foremost, I think, Bhavesh, you should be a professor. I mean, I've been listening to you. You your knowledge is another level. So, and thank you to Fission Well to have brought you on for this discussion. Amazing. So, I mean, I've been listening to you, and honestly, I haven't understood the entirety of it. But there are a few things that come to my mind, and I, want to just voice them. One is that, I mean, why do I get a sense? Why do I get a sense that, products are like flavors of the month, something comes, something goes, right? And I've been listening to your data. This sounds stellar. But if we just rewind, lots of products sounded very stellar, and we said, man, this is what to go in for. And honestly, I'm not an expert, so I look to Fission One, good, bad, ugly. They are the ones who manage it. But having said all that, I mean, we are all, individuals with very different profiles of investment risk, so on and so forth. Now, I mean, I just want to know what kind of, it sounds very interesting, but all these products have shelf lives. That is one. Number two is obviously, you do your research, you do your analysis, you've got your systems, so you can kind of, predict, evaluate, invest, suggest, so on and so forth. But so are the others doing. And as I said, it's got a shelf life. So what kind of horizon? I mean, is it difficult to guesstimate this, or would you like to hazard something to say? What kind of horizon are we seeing here?
So, Bhavesh, just before you answer, just a quick one. There is a small correction. This
Yeah.
is not a product. This is a category. And the reason why I'm saying that is a mutual fund is a category, SIF is a category, PMS is a category. Within that, you will have hundreds of products which will come in. So it's a different category with an investment vehicle. So fund managers may do well, fund managers may not do well, strategies may do well, strategies may not do well. And that's why we said it's good time to dip the toe. But it's a category, so it's not a particular. So again, I'm sure Bhavesh will have. I'm cognizant of time as well, but Bhavesh will have a quick response to that. But really, Bhavesh, his product may do well in a phase, may not do as well in a phase, but there will be many such products which would be this. Sorry, over to
Yeah,
Bhavesh.
thank you. Thank you for clarifying.
So I'll just give it in a very simple terminology. See, single asset or single product may come and may go. Like there was a euphoria for Bitcoin, then there was a euphoria for silver, then in between we saw euphoria for AI trades. So these are themes, single theme. It will keep on coming and going. Every 2 years you hear a new word, you learn a new word, you talk that is the biggest thing of the world, and after 2 years it vanishes and something new comes in. But investment vehicles like mutual fund have a track record of 30 years, PMS 25 years, AIF 15 years. So this will stay. Within that, within equity mutual fund also, there were few products which became hit, few products which didn't perform. Within Within PMS also, some style worked, some style didn't perform. The same thing will happen with SIF also. The advantage over here is there are multiple, I can say, asset allocation product over here. You have three equity fund, two fixed income fund, two hybrid fund, and mine. And you believe me, this is just the first version of SIF. In mutual fund today, you have more than 50 products. In SIF right now, they have just allowed seven very simple product. As and when they see the success, more and more AMCs participate in this, more and more distributor. So again, if you will see all this journey, what me and Abhitab have been talking about, the growth of 25,000 crore AUM. This is with only 9,000 distributor passing that SIF exam. Out of 1,50,000 distributor, only 9,000 have passed, and still the growth is 25,000 crore. Out of 57 AMCs which are there, and a lot new which are filing the license, only 12 have launched SIF. And within that 12, only 30 products have launched. So in mutual fund, there are 900 schemes on equity and hybrid side. In SIF, there are just 30 schemes. And that is where this flow number of 30,000 to 5,000 crore becomes very important. 900 schemes put together got 30,000 crore, and 30 SIF schemes got 5,000 crore. So definitely the early advantages here. See, the biggest advantage of SIF is not only the ease of operation of mutual fund, taxation of mutual fund, but also the flexibility to trade derivative. So if you ask me over next 5 year, can SIF become a 10 lakh crore, 15 lakh crore industry? 100% it has to. Unless regulation changes, someone complains, taxation goes for a toss, etc. In normal scenario, if we move with the current run rate, this is a 10 to 15 lakh crore product, and incremental flows will, right now it is 5,000 versus 30,000. Maybe in next 2 years you will see 50-50%. Because as right now there are only 12 AMCs. HDFC has not come, Axis has not come, Nippon has not come. A lot of larger players are not there, and even those who are there, like SBI, only have two product, ICICI have only three product, and a lot of us have only one or two product. Within this seven also, we have not completed the bucket. So once all these products are launched, I am sure incremental flow will substantially move towards SIF. It is not a single product, it is a vehicle. And that's why longevity of here will be much, you can say, stable compared to individual products and individual strategies.
Thank you. Thank you.
We are cognizant of the time. We are already 5 minutes over the time. So what I would request is, if you have questions, I'm sure you have, please send it either one-to-one or email it to your respective relationship manager or to myself. And Bhavesh, what we're going to take your help. Whatever questions we get, we will route it to you. If you could also share responses to that, we'll share it back to the respective participants.
Sure. More than happy to do that.
So thanks a lot. Thanks a lot to everybody for joining in on a Saturday. We don't want to take more time than what we have already budgeted for you all on a Saturday. So really appreciate that.
Thanks, everyone.
Thank you, everyone.
Thank you,
Thanks,
Vision
Bhavesh.
Wealth, for having me over here. Looking forward to more such conversation. Thank you.
Thank you.
Thank you. Thank you so much.
Bye.
Thank you. Really appreciate it.